Welcome to Season 5 of the SARE Ladies podcast. This is where Asian American Pacific Islander women carve out their own space in real estate and shake up the status quo. Join your hosts, Anita Wong and Ashley Cow, as they dive deep into bold strategies, personal growth, and everything it takes to own it. From building wealth to boosting confidence. Let's jump in. Welcome back to the SARE Ladies podcast, where we talk about real estate, representation, and rewriting the rules of wealth. I'm your host, Anita Wong, real estate investor, syndicator, and co-founder of Give Rise Capital.
And I'm Ashley Cow, commercial mortgage lender, investor, recovering tech employee, and your co-host.
So believe it or not, we are at the end of the year. And so we all know that, I know that most of you probably maybe do your taxes around the time it's due, but actually this is the best time to optimize your savings is actually at the year end, right? So we have joining us Amanda Han, CPA to the stars, real estate investor, and co-founder of Keystone CPA and of the author of Tax Strategies for the Savvy Real Estate Investor. And so if you've been on the SARE Ladies podcast before, she has been here and just, an awesome speaker. And since she's been on the pod, Keystone CPA has been named on the Inc. 5000 list. So there's been a lot of changes. Congrats, Amanda. That's so exciting.
Yes, thank you. Thank you so much. Yeah, it was very exciting to have one. And thank you guys so much for sharing my post on Instagram. That was so sweet.
It was so cute.
Yeah. And so Amanda actually also joined us at the conference. So she was on stage talking about taxes. And I remember we were at time and we had to cut the session. And I remember hearing like a subtle "aw," like from the audience. And so I love hearing that people wanted to talk about taxes. And so we're super excited to have you back on the podcast to continue the conversation. And so for this episode, we're talking about 3 common investor profiles. I think each of them have different approaches and challenges. And so the first profile is the W-2 investor. So you're working a full-time job, but you're also investing on the side. And then you have your business owner. So whether it be your real estate agent or a CPA, you're running your business and you're also investing. And then the last profile is the full-time real estate investor who may be living off their real estate portfolio. So excited to just get this conversation going. But before we jump into that, really wanted to just do some rapid fire questions to get to know you more, Amanda. So what is your most misunderstood tax deduction?
I speak to real estate investors all the time nationwide when I teach. And I feel like one of the most commonly misunderstood things about deductions is the fact that you don't have to have an LLC to take write-offs. And I think this misconception comes from actually CPAs and attorneys who go around telling people like, hey, you could write things off if you have an LLC or a corporation. And that's actually not true at all. The IRS does not care if you have a legal entity. You can write off the majority of your real estate related expenses, regardless of whether you have an entity or if you own, real estate in your personal name. So often misunderstood that LLC is a prerequisite to writing things off.
Is an LLC more so for like asset protection then? Is that kind of
Yeah. If we're talking about rental real estate, it is for asset protection purposes primarily, maybe a little bit lower IRS audit risk. But if we're talking about an active business, like what you were saying, if we're talking realtor or a consultant, then there are different strategies with respect to lower tax rates that we pay. But with respect to write-offs, it's pretty much the same, regardless of whether you have a LLC, S Corp, or just owning, running a business in your personal name.
Gotcha. What is your favorite write-off you personally love using?
Personally, even for my clients too, I just love any write-off where I'm not spending extra money on. I know a lot of people talk about, buy a car and write it off, or buy a boat and write it off, but that's really not what I'm trying to do. I think my favorite thing is always looking at what am I already spending money on anyways, personally, and how can I turn that into a legitimate tax write-off? So paying kids is a good example. I have a 7 and a 14-year-old, so my 14-year-old can do, a lot of stuff for the business. So I love that because I'm already giving him money anyways, but now I just force him to work for it. And by working for it, then I get a tax deduction.
Nice. Are you a spreadsheet girl, a calculator girl, or back of the napkin show off?
Oh, spreadsheet. I'm just looking at my calculator here. I don't think I've touched it in years, but
Okay.
as a CPA, I have to have a calculator, right? Even just for aesthetics. I don't think I've touched it. Everything is spreadsheet. Yeah, if my
Okay.
Excel's not working, I have a major problem.
Okay. What is one thing most people don't know about you?
I don't know if it's most people don't know about me. I think people might find it surprising, is that I have an extreme fear and anxiety around public speaking. I think I might share with you guys
Oh.
at the anti-conference, but because I speak so much, we speak probably, I don't know, once a month or every other month, just because one of our passions is educating people about tax strategies. But personally, I have a huge fear around public speaking. So I get nervous maybe about an hour before going on stage, like a mini panic attack that builds up until I go on stage.
Oh, how do you deal with that? Do you have like a ritual? Like
A
like
ritual.
Matthew?
Yeah, I don't know. I don't really know how I deal with it. I just force myself to do it. And I think my ritual is I don't think about what I'm going to say. So I
Mhm.
prepare like a day before, but the day of, the morning of, I don't look at anything anymore because then I just get more anxious if I'm looking at my note, my PowerPoint. So yeah, I just have to be over prepared earlier on so that the morning of is almost like, oh, I just happened to walk on stage. Here I am. But what I will say, because I think public speaking is a fear factor for a lot of people.
Mhm.
Um, but what I do really find is that after I get off stage, it is like the best feeling because I'm
Mm.
always like, wow, I did it again, So you're just like on a high of, yes, I did it. And I'll just go to the event host and be like, I would love to come back. And then I
Oh,
basically get myself into the next, fear factor for the following year.
yeah, I do too. I feel like I get too nervous, especially when I find out too much about the audience. Like I try not to read like who is in the crowd as much as possible. That like
Yes.
strikes fear.
Yes, I totally know what you're saying. Yeah, sometimes it's like if you're like, oh, okay, because people always tell me like, you know more about taxes than the audience. Like, okay, well that feels good, but then you'd have some like real estate guru in the audience, and I'm just like, oh my gosh, maybe that person knows more about taxes than me. They've been doing it for 50 years.
Right. Okay. Well, good to know that even those that have so much, so much speaking underneath their belt, and Amanda is probably one of our favorites because she is such a presence. I think even just talking about, accounting, she can be so interesting. So, I mean, face those fears if you have a public speaking phobia. Okay, well, let's dive into this segment, right? So let's set the stage. Amanda, can you just quickly summarize what has changed under the One Big Beautiful Bill Act and why it's such a big deal for 2026 planning?
The One Big Beautiful Bill, I hate the name, by the way, but it is really like it sounds. It is big from the perspective that it's sort of all encompassing. In the past, we would have a bill that will really be targeted towards large corporations or really wealthy people or very low income people. But One Big Beautiful Bill sort of has a menu for everyone, regardless of whether you're lower income, higher income, business, real estate, even retired people. So with the One Big Beautiful Bill came about a couple of brand new tax benefits that just never existed before. So for people who earn tip income, so whether as a 1099 or W-2, or earning overtime income, we have a lot of clients who earn overtime at their jobs, or medical professionals, government workers, firefighters, we, for the first time, have the opportunity to exclude up to $25,000 of tip or overtime income from paying taxes on. So that never existed before. Another really great one that was interesting and new is that for the first time ever, if you pay interest on your personal car, provided that it's, a new purchase and you're paying interest on it, if the car itself is made in the US, you can potentially write off up to $10,000 of interest income. And again, this is super significant because in the past, when we talk about car write-offs, it only relates to businesses or real estate. When we have a personal car, we never write it off. So this is really cool. Like even if you're someone just working a W-2 job and you have a personal vehicle, this could be a potentially big tax benefit. And I think just for individuals in general, if you own a home or you live in a high taxing state like California, New York, Hawaii, for so many years, we can only write off up to $10,000 on primary home property tax and state income tax. So the One Big Beautiful Bill basically 4x'd that benefit. So we can now write off up to $40,000 against our personal tax return. So those are all, pretty significant things that really impact sort of just like the everyday taxpayer.
Got it. What are the biggest permanent wins for taxpayers and which ones are only temporary?
So most of the stuff I just talked about are temporary. And temporary just means that, they're here, but it's not a permanent part of the tax code that we can expect to go on and on indefinitely. One of the biggest benefits that came out of the One Big Beautiful Bill that is permanent is 100% bonus depreciation. So all of us real estate investors, that's a very significant win, because before the law change, we were looking at 40% bonus depreciation for 2025 and then 20% for 2026. So the Big Beautiful Bill basically increased it all the way back up to 100%. So it's a significant difference, right, from 40 to 100. And then the other benefit was that the One Big Beautiful Bill, the bonus depreciation is a permanent tax change, which means it's not going to expire. We can expect to use 100% bonus depreciation on our business, on our rental properties, for, I guess, forever. I think a question I get a lot is it really forever? The law says it's forever, but we all know if there's another administration change, then, that's when maybe new tax changes come about. But for now, the term is, it is here forever.
And is that retroactive? So if when does it begin, I guess?
Yeah, great question. So so the law passed in, I want to say June or July of 2025, but bonus depreciation was retroactive back to January of 2025. But they didn't make it easy. It wasn't like all of 25. It was only available for, if we're talking real estate specific, properties you purchase and place in service after January 19th. So inauguration date, basically. If you're someone who bought in January 1st through the 18th, then you still have to use the old law, which is 40% bonus.
Gotcha. Okay. Well, so now I want to jump into the three profiles, right? So the common investor profiles. And the first one is probably the most common, is the W-2 employee who also invests on the side. So that's like your software engineer, your nurse, your teacher, and so on. And, they're working their full-time job and also investing in real estate on the side. So if that were me, what are the most important tax strategies that I should be thinking about right now?
The strategies are going to be different, even though I know we have kind of three profiles, but the income amount of that person or the household does play a role in what kind of strategies makes the most sense. But, from a high level perspective, if you're someone who makes $150,000 or less, so let's say you make $100,000 for the year, you can actually invest in any kind of rental property, so long-terms, mid-terms, and you can use up to $25,000 of rental losses against W-2 income. So this is just available for anyone. If you're like a teacher or a part-time nurse, you can use up to $25,000. If there are that amount of losses from write-offs and depreciation, you can use up to $25,000 against different types of income. But if your income is above $150,000, then generally your rental losses are considered passive, which means we don't lose them, but we can only use it to offset passive income in any given year. And whatever we don't use, we sort of carry it forward. So the downside of that is then we're not offsetting taxes from our W-2 income.
Right.
And the loophole around this limitation is either you are a real estate professional or you marry somebody who is a real estate professional. And there are a lot of rules around like what you have to do to qualify as a real estate professional. But one of the ones that's hardest for people to meet is you have to have more time in real estate than your job. So for someone who's working, like you said, full time in tech, it would be very difficult, if not impossible, for them to have more hours in real estate than their job. So the workaround is, marry a real estate professional if you're unmarried, or if you're married, see if it makes sense for your spouse to become a real estate professional. But the reality is we do have a lot of people who just will not be a real estate professional. Like maybe you have two doctors and neither of them are going to quit their job to do real estate, or you have a single person who's like, well, I'm not going to get married. I want to just have real estate be a side hustle. One strategy to still use real estate to offset W-2 income is to invest in short-term rentals. And it's what we call the short-term rental tax loophole, where if you invest in short-term rentals like Airbnb, you can potentially use the Airbnb losses to offset W-2 income, even though you're working full-time, even though real estate is just still a side hustle. But you do have to make sure you meet all of the requirements by being hands-on and involved in the day-to-day operations of the short-term rentals and meeting material participation hours.
Right. Okay. And so how does the strategy change if, say, like I'm an active investor managing my Airbnb, or like I'm rehabbing a rental, versus I'm a passive investor where I'm maybe contributing capital to like a syndication?
Yeah, I mean, if you're an active investor, so, in what we were talking about, if you're doing short-term rentals, right, you
Mhm.
self-manage and you meet the material participation hours, then the Airbnb losses can offset all types of income. If you are passively investing, whether it's Airbnb or your own long-term rental that you just don't have any hours on, or I'm just giving money to syndication and they're doing whatever they do with my money and I get a loss. Generally, those are going to be considered passive losses, which is still good. I think a lot of CPAs say that's really not helpful, but I, on the other hand, think it's very helpful because I am still able to generate income from my rental properties or the syndication where I'm not paying taxes on that money. So I'm getting cash flow, I'm getting distributions, but I'm also not paying taxes because I'm still using depreciation and write-offs against that income that's now being generated, right? The only detriment to all this is that I'm not able to use all those losses currently to offset W-2 income for tax purposes. But again, I don't lose it. I get to carry it forward and offset future income, which I expect to make, right, as a real estate investor. And if the worst case scenario happens, let's say that, my rental or the syndication goes down and there's just no income at all, when the property is sold, I do get to utilize all of those accumulated losses against my W-2 income. So the tax benefits are kind of always there. It's just a matter of when do I get to benefit. For active investors, on the other hand, if you're like a realtor or you just do real estate full time, you don't have another job, then generally it's much easier to be a real estate professional, and then your rental losses could offset all types of income, including a spouse's income if you're married.
They should really create an REP, like real estate professional dating platform.
Yes, they should. So
Looking for my
I
REP.
spoke. Yes.
There's a pun in there somewhere. I'll figure it out.
I taught at an event. I spoke at an event that was a bunch of doctors, a
Mhm.
real estate investment, also mostly doctors. And then I went to visit my friend Thatch. And you've had Thatch in your event. So I went to visit Thatch because he had another event. It was like a bunch of real estate investors. And I was like, man, there's a group of doctors here looking for real estate professionals. And I got a group of real estate professionals here. They were on WOVA or something. Like, how do I merge that?
And take a
Swipe
commission.
left, swipe right. Yeah.
There's something here.
Yeah, there's something there, and you can make
Coffee
money
with
off of it.
Mhm,
Okay.
mhm.
Well, let's talk about our next segment, the business owners, the agents, flippers, loan officers, contractors. If I run my own business, what tax strategies should I be thinking about in 2026?
Well, so we just talked about how, like, if your business is real estate, right? Realtor, property manager, what was the other one? Flipper that you said. syndicator, then odds are you can likely qualify as a real estate professional because your business is real estate, right? So which then just means if you own rental properties, then you can use the losses against all types of income. On the other hand, if we're saying a business owner's business is outside of real estate, so a lender or a CPA or just somebody consulting, a doctor, then you can only use the losses against W-2 if you're using either the short-term rental tax loophole or you're married to someone who's a real estate professional. But some other strategies we look at a lot, especially towards the end of the year, is how do we optimize the way we take money out of our business? And hopefully, if you are operating an active business, you have a legal entity, right? Normally, we look at S corporations for active business. And the reason is because S corporations help you to reduce self-employment taxes. So, on $100,000 of income, we typically see somewhere around $7,000 or more in annual tax savings just by operating inside of a corporation. So one of the things to be looking out for before year end is taking a look at, am I in the right type of legal entity? And if not, if I have an LLC, but I should be an S corporation, then can I just make an election to now be taxed as an S corporation? When we have a legal entity, we're always looking at how do we take money out of the business? Is it an owner distribution? Do I run payroll? Do I reimburse myself? Maybe I paid for some business expenses personally, by accident. So making sure I reimburse myself so I can take a write-off for it. So these are the kinds of stuff that, we want to be taking a look at for business owners. And of course, one of my favorite ones is putting money towards retirement account. Because one of the things we always look at is, hey, if you're looking at a high tax bill, then the decision to make is, would I rather pay the IRS or would I rather put that money towards retirement? And with retirement accounts, there are ways to contribute, $60,000, $70,000 or more into retirement where you get a write-off. And that money could be used to invest in all types of assets, including rental real estate too. So you kind of get the best of both worlds.
So how should business owners and time income or major purchases with the upcoming bracket changes? Do you think there are benefits to accelerating deductions in 2025?
Yeah, that answer is also going to be different depending on the person, right? Because what we're looking at is what is your tax rate this year versus next year? Obviously every year there's tax rate changes to the brackets, but what I'm more interested in is what is your tax bracket? So if, for example, this year you had a windfall and you're in you're in the 37% tax bracket, but next year we think it'll be normalized, it'll be in like the 24% bracket, then yes, I would consider prepaying expenses. I think I might go to a conference. I'll probably buy those tickets now. I'll probably book my hotels now. I'll book my travel now. If I would kind of do the opposite for income. So if I can hold off on billing for a client, invoice my client, or I can defer closing on the sale of a flip property, even by just one day from December 31st to January 1st, that one day delay delays the taxes for a whole year. And it also just gives me more time to strategize. If I have a big windfall, like I sell property for a huge gain for, $300,000 in December, I have almost no time to redeploy that money. But if I waited to close in January, now I have all of 2026 to think about what, can I buy more rentals? Do I marry a real estate professional, right? All of those things, because you have all year to work on that.
Interesting. This is also probably like a question for me personally. So you said earlier, is a lender qualified as a reps person?
Mm-hmm.
Okay.
Great question. Yeah, I knew you were going to have that question because since you mentioned lender. So that is a common misconception that people think lender is also reps, and it's actually not, unfortunately. So they don't consider, dealing in notes and loans part of real estate. Same thing for like me, real estate CPA. I work with real estate pretty exclusively, but I'm still a CPA more so than real estate. So lenders, unfortunately, is like if you get paid as a lender in your loan business, that is not real estate hours.
Gotcha. So you have to be working in something that's specific for like a real estate agent.
Yeah, so the common ones, so real estate, agents, brokers, property managers, wholesale flipping, anything in construction, right? Is real estate construction. Yeah, those are, they say like build, manage, invest, development. Those are all real estate activities. But the other sort of peripheral advisory roles are not part of real estate professional hours.
Gotcha. Okay. All right. Well, I want to jump to the third profile, which is the full-time real estate investor. So those are the folks who are probably living off their portfolio. So what should these folks be thinking about in for 2026?
And living off of your portfolio, it could be sort of vague, right? So I could be someone who's still actively working in real estate, like I'm a broker and I live off of my portfolio because I just take my brokerage income and invest in real estate. Or I can be someone who's sort of just like retired. I don't do anything. I just invest in maybe a couple turnkey rentals and syndications, right? And so the tax strategies for those two profiles are further kind of separated. So again, if you're full-time, 1099 is in real estate, then you're a real estate professional. And that for us, from a planning perspective, that's super easy because it's just make money in real estate business, take that money and put it to rental properties, do cost segregation, all the benefits offset all types of income, right? So that part of it is easy. If you're someone who's, let's say, just retired and passively living off, or maybe not retired, semi-retired, and you're just living off of portfolio income from your rental properties, that's also not super bad because most of our clients in that scenario don't have much active income. So if all of their income is passive from real estate or just other business investments, then the rental losses do offset passive income. I know we typically think about if I passively invest in a rental that has a gain, I invest in a syndication that has a loss, they offset each other because it's real estate versus real estate. But the same exact thing works for real estate versus business. So we had a client last year, they invested in a captioning business, like they do closed captioning for TV. And they were passive investors. They didn't work in it. They were just like the money people. And that business sold for, I don't know, like $1 million almost or something like that. And so what they did was they just took some of that money, invested passively in real estate syndications, and those K1 losses offset income from the business that was sold simply because both were passive to that specific taxpayer.
So it's just the bucket. It's like the passive bucket doesn't have to be just real estate. It's just as long as it's categorized as passive.
Yep, exactly. And so you can imagine from a planning perspective, it's like, okay, well, if we can't be real estate professional, then how do we become passive in these other things that maybe we're only peripherally involved in, right? Let's be passive. And so we can, like you said, just live off of the rent checks coming in.
Right. And so when does it make sense for like a full-time investor to consider like cost seg or bonus depreciation? Like, should they consider it this year versus next year? Or like, how do you plan for that?
It's going to be different from person to person. One of the common misconceptions is people think cost segregation is only available for full-time investors, and it's actually not. Anybody can do cost segregation. It's just a matter of when it would make sense for you specifically. So, earlier we talked about, hey, what if you work full-time in tech and you bought a short-term rental and you're using the short-term rental loophole? Well, if you're able to meet the hours requirements for, being actively involved in material participation, then I would do cost segregation for this year, right? I want to do it in the year where you can use the losses against all types of income. Or if, like for me, I'm a CPA, I've invested in some rental properties, I'm selling one for a gain, and I don't want to 1031 exchange it, well, I can cost seg some of my other properties and use those losses to offset the gain on the property I just sold, right? Now, for someone who's doing real estate full-time, it's a much easier decision because if you have income and you want to offset it, then you can just cost seg the property, naturally offset because you're already a real estate professional. But the strategy itself can work for all types of people, not just full-time real estate, just a matter of strategizing with your CPA on when should you do it, what year, and which properties. For people who have multiple properties, we don't always cost like all of them at the same time. Sometimes it's like, well, maybe I'll do 2 this year and 2 next year just to even things out. So I get myself out of the highest tax bracket, but not necessarily like get to zero tax.
Okay. So, final question here. If you had to give every investor in these categories or just in general one action item before the end of the year, what would that be?
Oh my gosh. Do year-end planning. I think something you guys mentioned, like, oh, some of you probably do your taxes at the last minute. And that's why most people, most people that I meet, a lot of people don't even know what year-end planning is. So year-end planning is basically getting together with your CPA, your accountant, letting them know what's already happened this year, where your numbers stand, and then they could advise you on, okay, here are the 3 to 10 things that you should consider doing before the end of the year. And if you do those things, here's how much taxes you'll save. And the reason that it's so important is because where your numbers fall on December 31st will determine, for the most part, how much or how little taxes you pay next April. So people always think, I need the best tax preparer because I'm going to pay the least amount of tax. That's not actually true, right? You need to have the best tax strategist. You need to be doing planning before the year's over, because then, regardless of who files their tax returns, they're working off of the same numbers, right? So we talk about paying our kids. We can't pay our kids after the year is over for this year, right? If we want to write it off in 2025, we have to pay them now. We have to document it now. If we want to prepay some expenses, got to do it now. If we want to defer income, we have to make sure we talk to the buyer so that it's deferred until next year. So the one thing, regardless of which category or, which taxpayer profile you're in, really important to try to take the time and meet with your accountant and, have that conversation at least, just to make sure that you've done everything you can. And, we're talking 2025 year end, but what you do this year also impacts how much taxes you pay next year too, right? Are we shifting income the right way? If we can't buy a property this year, then can we buy it next year? Do I earn the hours next year rather than this year? So it's all sort of interrelated.
I think you made a good point where there's a difference between like a tax strategist versus just somebody who files your taxes. And I feel like I get this question a lot because I think people have challenges finding an actual tax strategist like you. So what are some things that people can look for when they're vetting, and what kind of questions can they ask to kind of see that they align, and this tax strategist knows what they're doing?
Yeah. I'll tell you what not to ask. Don't ask,
Okay.
do you work with real estate investors?
Okay.
Because 100% of them will say yes. And that could just mean like they have one client who turned a home into a rental, right? And that's not very helpful. So a better question is, what are your successful real estate clients doing today? And it's not even a tax question, but you just want to know, like, what, they'll tell you a story about a successful client. And I think that'll give you insight into who they think is a successful client. If their story is like, oh, my client owns, I have one client who owns, 30 apartments and mobile home parks. Like, okay, great, because that's kind of what I want to do. But if their success story is somebody who, bought a duplex and, lived in one unit, like, then that's probably not someone who you can grow with if you're kind of already there, right? So just ask better questions, but also just common things like, what's your process for planning? How frequently do you meet with clients? What are some strategies you use with like some of the things you ask? What's your favorite real estate tax strategy? Just the more open-ended the question, the better it is, because then you just let them talk and take the conversation where it goes. But I think also just ask around for your friends, fellow investors, who they use, what their experience has been. It's very tough to find CPAs who are well-versed in real estate. It's hard to find good CPAs in general. And I think I was just looking at a research that said like over 75% of accountants or CPAs will retire in the next 10 years.
Wow.
So the problem is going to get worse. And so I have a group of colleagues that, we're always talking and thinking about like, how can we just push this information out to more and more people? And not a lot of people want to become accountants too, because they think AI is going to take over the job. So we have a huge issue of like, it's going to have a huge issue of supply and demand, and just kind of how do we then just educate the taxpayers directly, right? So you take more control of, here are the things I know I can do.
I almost want to ask you that first question. I feel like you just generated your own question. Can I ask you that? What are your most successful real estate investors doing?
You know, when I think, so for me, it's a wide range, right? Because we have clients who like, you know, work in tech or doctors, full-time W-2, dabbling in real estate, all the way to people who are probably some of the largest syndicators in the US that deal with all the different asset classes. So for me, success, I don't look at it from a number of doors perspective. I could do that, but I feel like success for me is I'm looking at how they're scaling their business. Because I'm also a business owner and investor, so that's the kind of stuff that fascinates me quite a bit. But one common thread I see in successful clients in our portfolio, in our client portfolio, is they tend to be pretty wide in what they do. So, for example, success found in investing in real estate, and then start coaching people and teaching people how to invest in real estate, right? So making money from like maybe education coaching kind of stuff. Also, success in real estate results in me forming a property management company because I see the problems of my, you know, other investors who can't get good property management. So kind of building out the different layers where they see the need to provide more comprehensive, I don't want to say service, but more comprehensive assistance to other people who are investing in real estate as well.
Yeah, I remember having a conversation with Tony Hong, and he was like, the average person that, you know, that is definitionally financially free or wealthy have 12 streams of income. I was like, you think it's that high? So you're kind of like, you're branching from one thing into, you know, coaching, and then like, I don't know, merchandise.
Yeah, I don't. So I think, I mean, 12 is a lot. So I mean, for most of our clients, probably not 12. But yeah, I think most of our clients have, the ones that are like pretty successful usually have two, right? It's a real estate investment as an investor, and then separately something that is an offshoot of that, whether it's education or property management or real estate brokerage or even a loan company, right? Or CPA firm for me. I typically see that very strong in both. I have a couple clients who have maybe 4 or 5 offshoots of that. But yeah, those are like the, you know, the very successful ones that they have teams around each one of those. So yeah, I mean, I think to be, you know, really good at 12 streams of income, yeah, that's got to be like a pretty big company, because you don't want to become a jack of all trades where you're like, I'm doing a little property management, a little bit of a course, and none of them was like doing really, really well, because now I'm just very diluted in my time, right? I want to be laser focused on 2 or 3 things that are going to generate the most ROI of my time.
Yeah, I do think that he's including those that are entirely passive. So like, you know, we have like, you know, syndications or whatever that you've already built systems for. I don't expect anyone to have 12 like full-time businesses. That would be absolutely insane. But, you know,
yeah. Sure. Yeah, if we say we have, okay, so yeah, syndications is one stream, interest income from a CD, if that we consider that a stream, then yes.
Yeah. Yes, is by definition.
Well, I know we're coming at time. So in my head, I'm like, oh, because I still have more questions. But
you can just call me offline.
I know. Well, I really appreciate the time today, Amanda. This is all really good. I just love how you break it down, and it's just so easy to understand. There's no like crazy technical jargon, and I feel like I've gotten that a few times from folks, and I'm like, I'm lost already. So I just love that you break it down so easily. And uh, you know, I think that there is. I like that in this new bill that there's something for everyone that you mentioned. So there's a code for everyone. So I think that's interesting to see, and I'm interested to see how this plays out. But thank you for breaking down how it plays into the different profiles that we made today. And you know, we hope to have you back again, because like I said, I have many questions, and I feel like the tax code's always going to change. So thanks for today. And Anita, do you have any other comments?
Yeah, well, before we let you go, do you have any 2026 events or plans that you want to have our listeners know about? And if so, how can they find out more about it?
Oh my goodness. I'm sure I have 26 events already on the calendar for where I'm teaching at. But the only one that comes off the top of my head, I'll probably be teaching at BiggerPockets again. I'll be teaching at the Best Ever Conference. I don't know if either of you guys go to that one. That's kind of the big syndication one. But the best place to find out where I'm going to be is probably on Instagram. So I post there daily, just, kind of short tax tips. And my handle is Amanda Han CPA. I also have a YouTube channel as well with, for anyone who's looking for more in-depth tax content, also the same handle, Amanda Han CPA.
Cool. Well, again, thank you, Amanda. If this episode helped you figure out your tax strategy for 2026, share it with a friend. And if you liked it, give us a review. If you did not, forget about it. And we'll see you next time on the SARE Ladies podcast.
Bye, friends.
Thanks for tuning in to this episode of the SARE Ladies podcast. If you enjoyed the conversation, make sure to follow, share, and leave us a review. It helps more women in real estate find this community. And don't forget to connect with us at sareladies.com for more resources, stories, and support on your investing journey. Until next time, keep building, keep learning, and keep breaking barriers.